Will the 2020s be worse than the 1930s? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over real GDP growth data from the modern day and compare it to what happened during the Great Depression, the 1930s into 1950. So we start with this chart of real GDP growth going back to 2000 all the way to today's date. And when we say real GDP, what we're doing is we're taking nominal GDP and adjusting for the rate of inflation. We want to see how much the economy has grown. And if only prices went up, that doesn't necessarily mean that we have greater economic output. So on the left, we go from 13 trillion up to 20 trillion. And in 2000, we start about 13 trillion. We go up to about 15.7 prior to the GFC. Then that comes crashing down, bottoms out around 2009, 2010, and then goes up. But you'll notice that it goes up at a lower trajectory or a slower pace than it did between 2000 and 2007. More on that in just a moment. So then prior to the cerveza sickness, we top out at about 19.2 trillion. So between 2008, say between the GFC and 2020, the cerveza sickness, the economy grew by about $3.5 trillion or 22% over this 12-year period. Now, the first thing I want to point out is this is way under trend. And this is what I was talking about earlier on the chart. If the trend would have continued, we would have been at 23 trillion. Right now, we're at 19.8 trillion in 2022. That's a discrepancy of $3.2 trillion in economic output or economic growth. This has a massive impact on the standard of living. But let's compare that to what happened during the Great Depression. This is the same chart of real GDP going back to 1930 all the way to 1950. Now here we start at $1.1 trillion. We fast forward 12 years, just like we did here, and the economy grew by $700 billion. Notice, during the Great Depression, the 12 years from 1930 to 1942, the economy grew by 63%. During this 12-year period, the economy grew by 22%. Now, you may say, well, George, that's not really fair because we had all the government spending because of World War II. Okay, didn't we have just as much government spending during the cerveza sickness in 2020 and 2021? But let's take it out even further. Let's go 20 years from 1930s to all the way to 1950, right here. The economy grew over this 20-year span by 100%, going from about 1 trillion all the way up to $2 trillion in real GDP. Now let's compare that to what happened from 2000 all the way to 2020, or even today. If we would have grown from, let's say, 2002 to 2022 at the same rate, our real GDP should be at $26 trillion. That is a discrepancy of more than $6 trillion. Said another way, our economy should be about 30% larger. The standard of living should be 30% plus better if we would have grown the same way we did during the time frame that included the Great Depression of the 1930s. Now, I know a lot of you right now are saying, yeah, George, but we didn't have that huge unemployment that they had during the Great Depression, so you can't really compare the two. Well, time out here. We've got to understand that during the 1930s, the unemployment rate was measured much differently. In fact, they didn't include a lot of the government employees or the government workers that the government was just basically paying to dig holes and then fill them back up again. That Keynesian approach to getting out of the Great Depression. Those people weren't even included in the unemployment rate. So if you took out half the government workers we have today, I think the unemployment rate would probably be close, if not higher, than we saw during the Great Depression, especially when you look at the real unemployment rates going back to the cerveza sickness in March of 2020. So can we really say that our economy was that much better during the 2010s just because our unemployment rate wasn't as high when we weren't producing even the same level of goods and services? And at the end of the day, wealth isn't measured by the amount of currency units a society has, nor is it measured by the number of jobs it has. It's measured by how productive, how many goods and services it is creating efficiently. Another example I'd give you is look at communist Russia. The unemployment rate there was incredibly low. Does that mean that they were in an economic boom? Absolutely not. You can be in an economic depression where GDP is contracting and still have a low unemployment rate. Lastly, I'd like to remind every single one of you who's watching this video right now, you don't necessarily have to have prices going down to have an economic depression. You can have an inflationary depression. A good example would be Venezuela. Is anyone going to argue that over the last decade, their GDP growth has expanded? Maybe in nominal terms, but definitely not in real terms. And I can illustrate this further by pointing out what has happened to the living standards. I got to give a huge hat tip to my good buddies, Emil Kalinowski and Jeff Snyder, that pointed this out in a recent podcast episode on how economics has maybe contributed to the mass formation psychosis that Dr. Matisse Desmond has talked about with Chris Martenson and Dr. Robert Malone talked about with Joe Rogan. But their point, or the statistics they bring up, is to show that look at the rate of homelessness in the United States. I'm sure every single one of you watching this video has seen the amount of homeless people in your area skyrocket over the last 10 years. Would that be something that's consistent with an economic boom or an economic depression? Next, drug use skyrocketing. Depression, same thing. Life expectancy in the United States is actually going down for the first time. Again, another thing that you would expect to see in an economic depression. And then the birth rate is flatlining. It's under trend, just like GDP growth. So then the question becomes, are we going to see more of what we saw in the 2010s in the 2020s, or is it actually going to get worse? By the end of this video, we're going to try to answer those questions specifically to find out if the 2020s will be worse than the 1930s. Step number 2, the bifurcation of society. To illustrate my point, let's go over a chart going all the way back to 1970 to today's date. And on the left, we go from 3 times up to 7 times. Now, in my whiteboard videos, I often use a chart of housing prices adjusted for inflation going back to 1900. But one chart we rarely go over that is just as important is not just home prices, but prices compared to income levels in the United States. So we start in 1970, and home prices were about 5 times the average U.S. income. And we go down to 1975, it gets a little bit cheaper. We go up in 1980, and you can see it stays pretty consistent until we get to the 1990s, and then it really comes down. I think wages went up significantly, and home prices came down. So wow, you could really afford a home easily in the 1990s. And then in the late 90s, going into 2000, we know what happened then. We go straight into the mega bubble in 2005, 2006. I want to point out that at the peak of the insanity, prior to the GFC, this ratio got to 7 times. So the average home price was 7 times the annual income. After the housing bubble burst, we came back down to more normal levels, historically speaking. But now in 2022, we're even higher than we were at the peak in 2006, where the ratio is over 7 times. The rebuttal would be, yeah, George, I get it, but if home prices are that expensive relative to income, then maybe the home prices will most likely come down in the future. And that's a good observation, but we have to remember that we could go into a recession, an economic depression in the 2020s that is actually inflationary. And if we get consistent price increases of consumer goods and services, usually wages don't go up at the same rate. But this level of consumer price inflation could exceed the actual increase in home prices. Let me give an example. So let's just say that wages are going up by 5% per year. You say, well, George, well, that's great. And not really, because home prices could be going up at 7% per year, meaning this line would continue to go up. Homes would be more and more unaffordable. But we could see an inflation rate of 10%. So what this means is home prices in real terms could be coming down, while at the same time, home unaffordability could be increasing. And it's not just homes that are becoming more and more unaffordable. So are automobiles and air travel. I want to point out that has a lot to do with freedom. And so if prices are going up, fewer people can afford these luxuries, if you want to call them that, and therefore their personal freedom would decrease as well. And we're going to get to how that plays into an economic depression in just a moment. But I also want to point out the fact that Jerome Powell, the Federal Reserve, is talking about increasing interest rates 3 times in 2022 alone, and who knows what we'll see going into 2023. So if interest rates are increasing dramatically, that means affordability for homes and automobiles for the average Joe and Jane goes down even further. Now I want to go back to this question of what is wealth, because it's very difficult for people to get their heads around. It's not green pieces of paper or currency units. We saw that in communist Russia back in the 1950s and 1960s, where they had plenty of money, but they still had to wait in line 4 hours just to buy a loaf of bread. So they had plenty of currency units, but no stuff to buy. Therefore, by definition, they were poor. So now let's look at the 1930s through that lens. So there might have been stuff to buy, but people didn't have any money, but the net result was still the same. And that is people don't have access to a lot of stuff. This is really why the Great Depression was bad. Again, it's not necessarily because people didn't have money, it's they didn't have access to a lot of stuff because they didn't have money. But the Russians didn't have access to a lot of stuff, although they had money, because there wasn't any stuff to have access to. So the net result is still the same. And let's not forget about Venezuela. Their nominal GDP is going through the roof. Their stock market, all-time highs. Housing market, all-time highs. But they're going through a massive economic depression because of hyperinflation, which means they don't have access to a lot of stuff. Let me use these 2 circles to illustrate my point even further. We've got the average Joe right here, and his cousin will say this guy's name is the fat cat. He is super rich. You can tell by those awesome shades he's wearing. And in a normal US economy, let's say there is this much stuff. And the average Joe makes about 50 or 60 grand a year. So he has access to, let's say, 50% of the stuff in the real economy. Well, the fat cat is really rich. So he has access to 100% of the stuff. Well, now let's think through if we have one of these circumstances. an economic depression like we saw in the 1930s, or communist Russia, or hyperinflation in Venezuela. The amount of stuff available decreases substantially. That's why we have a smaller circle here than we have right here. So the average Joe, because of this bifurcation and because we have less stuff, now he only has access to 10% of the goods and services because he's been priced out of the market for pretty much everything. Well, the fat cat still has access to 100% of the stuff, but the amount of stuff available has decreased. Therefore, by definition, the average Joe and the fat cat are poorer, regardless of whether we go through a 1930s style economic depression, communist Russia, or Venezuelan hyperinflation. It's still the same at the end of the day. And that's why, looking into the 2020s, we need to focus specifically on how much stuff, how many goods and services we will have access to in the United States. More importantly, how many goods and services will the average Joe and Jane have over the next 7 or 8 years? Because I can tell you definitively, in fact, I don't think I have to tell you this, that the average Joe and Jane has access to a lot less stuff now than we did in 2019. So the question becomes, is this trend going to continue, and is it going to get worse? Step number 3. Now let's go over the odds of a recession or even an economic depression increasing going into 2022 and possibly leading into a decade that's worse than the 1930s. I want to start off by going over a chart going back to 1955 all the way to today's date. On the left, I've kind of modified this chart slightly just to make it easier to understand my point. So we go from 0% up to 3%. Editor, go ahead and throw up the original chart, and this goes actually down to a negative 4%. What this chart is the 1-year treasury minus the 10-year treasury. So if we have a positive number, what that's telling us is that the yield curve is inverting. In other words, the yield on the 1-year treasury is higher than the yield on the 10-year treasury. So now these red dots indicate when this yield curve inverts. The blue lines indicate when we had a recession. So we start off about 1957, we have a recession 1960, 70, 74, 80, we had a couple there, I kind of combined them, 90, 2000, GFC, cerveza sickness. What I want you to notice is that every single blue line recession is preceded by a red dot or an inversion in the yield curve using the 1-year and the 10-year. Another common one they use is the 2-year and the 10-year. So what we can conclude with this chart is if we have an inversion in the yield curve, there's a 100% chance of a recession, if history is any guide. Also, that there has never been a recession, just on this chart going back to 1955, without an inversion in the yield curve. So if we want to try to figure out what the probability is that we'll have a recession/depression going into 2022 that could lead to an economic depression like we saw in the 1930s for the rest of the decade, we've got to try to figure out what are the probabilities of the yield curve inverting now, therefore bringing us into that next recession/depression. So one thing I'd like to point out that Jeff Snyder and Emil Kalinowski, again, their podcast is Making Sense Eurodollar University, they highlighted the other day that the yield curve is flattening. Now, it's not inverted yet, but if we look at the 2s and the 10s, it is flattening. So then let's think through what the Fed might do in 2022 if we take them at their word. they're going to raise interest rates 3 or 4 times. Okay, that takes Fed funds up to around 1%. Well, if we go back to 2018, just prior to the last inversion, we see that there was about a 50, 60 basis point delta between Fed funds and the 2-year. So let's just ballpark it and say that if the Fed takes rates up to 1%, that's Fed funds, that the 1-year will be at around 1.6%. And these are just ballpark numbers just so we can go over the concept. Right now, the 10-year Treasury is trading about 1.8%. So to distill everything down to one simple number or one simple question, we just say, what is the likelihood of the 10-year Treasury going below 1.6% throughout the rest of 2022? And remember, that's only a 20 basis point drop. And before you answer that question, I want to point out one other thing about the relationship between the stock market and the economy. I see it like this, as an inverted pyramid. This is the real economy. And this gentleman represents the stock market. Now, he is one of these carnival people who balances everything on their nose. And I try to throw up a picture of one of those guys, maybe one of these circus clowns. So you can imagine the circus clown balancing this huge inverted pyramid on his nose. He's just walking around going like this the whole time, and it's kind of shifting this way and shifting that way. To me, this is how precarious the United States economy is right now. And if we lose the stock market, we lose the clown that's balancing the entire house of cards on his nose. And if the stock market goes down and takes the economy down with it, especially if it comes down in a disorderly fashion, this would increase the chances that the 10-year Treasury goes down to, call it 1.6%. Let's go back to March, or during the cerveza sickness, the yield on the 10-year Treasury got all the way down below 1%. Let me be clear, this is not a prediction that the 10-year Treasury will go lower than 1.8% or lower than 1%. I'm just pointing out the path on how we could get there pretty easy. We're still in an inflationary environment. So if an investor is buying a Treasury, they're taking a significant negative yield. I don't think any investor wants to lose money, but they may prefer to take that 1% yield on a Treasury than hold cash in their portfolio. We'll just have to see how it plays out. And one last thing that I would like to remind you, that if we lose the clown, which is basically the stock market, and if the real economy comes collapsing down, what happens to the access that the average Joe and Jane has to stuff? That decreases as well. So whether we're in an inflationary environment, a deflationary environment, a disinflationary environment, for the rest of the 2020s, in my opinion, the average Joe and Jane will become poorer because they won't have access to the same amount of goods and services, just like we saw during the Great Depression in the 1930s. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.